Ouch, that's going to leave a mark. Of course, the S&P 500 was down over 1% today. It was hammered based off of a whole bunch of different news. I would say the story of the day is that the U.S. Treasury bond did hit a 3% yield for the first time in several years here today. That caused a lot of negative reverberations amongst those interest rate sensitive areas of the economy. In addition to that, of course, we had some remarks from President Trump regarding Iran and maybe some threats about how he would handle things if they restart their nuclear program there. And we did have some lousy earnings reports from companies like Caterpillar and 3M. So a lot of things going on here. I want to show you some new charts I've been working on here today as well. And then we're going to focus our trade application example on a stock in a sector that's been hammered this week, but not until today did we get a bullish cluster. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon VanZee. It's April 24th, 2018. Welcome aboard. If this is your first time watching the Market Outlook video, we want to say thank you for that. Remember to click subscribe in the YouTube area there if you want to continue to be alerted whenever we produce these videos going forward. In addition to that, if you wouldn't mind giving us a thumbs up if you get value out of these videos. David and I do look at those numbers on a daily basis, and we tend to think that if we get more thumbs up and likes, then this is something that you guys want us to continue. Obviously, this is a free product that David and I do here, so it does take time out of our day. But you guys have been doing a great job with that, so thank you for that. You can also scroll down on YouTube to leave comments for us if you desire. And then in addition to that, we do have a description area with a whole bunch of different links in there. One link in particular will allow you to sign up for our email distribution list, which means that you'll then receive an email letting you know whenever these Market Outlook videos have been uploaded. It'll also give you all of the stocks that are giving you bullish and bearish cluster signals in the S&P 500 for that day. So I imagine that today we're going to have a whole bunch of bullish clusters, in other words, oversold clusters based on that signal here today. So be on the lookout for that. Now, in addition to YouTube, David and I are heavy users of Twitter as well. We'd encourage you to follow both of us and the company handle. My particular handle is at Brandon VanZee, all one word. The company's is at market_scholars. And of course, David Settle is at DavidSettle42. Now, in addition to that, we would encourage you to click a like and retweet on Twitter to make sure that you're letting us know that you want us to continue these videos going forward as well. Generally speaking, if we can get 100 likes on Twitter for this particular tweet, I have no problems with it at all. And the last time I did the video, I think there were 109 likes, so you're not going to hear any complaints out of me out of that. Once we start getting below 100, then we start questioning whether we need to do these videos on a daily basis, or maybe we just do them a couple times a week or what have you. So keep up the great work on that end. Just get in the habit of clicking like on that Twitter tweet that's usually pinned to the top of my timeline, or David's if he's doing it on that particular day. Now, in addition to Twitter, we're also on Facebook, so make sure you're joining our Facebook group. We've got basically 1,000 of you in that group right now, and nice fun environment there online. So with that, let's go ahead and take a look at the markets. As you can see here, I've got a different chart pulled up to begin my analysis. Now, this particular chart is what I would call a yield curve chart. And what you see plotted in front of you with these different lines are the different maturities of the U.S. government bonds that exist out there. And it kind of gives you a sense of how the yield curve is currently shaped and whether we have any inverted portions of the yield curve, which of course we don't. But the main reason I'm bringing this up to start our conversation tonight is, of course, what I mentioned in the intro. Today, the 10-year hit a 3% yield for the very first time in probably about 3 or 4 years. I believe the last time it occurred was in 2014. And so on this graph in front of us here, you can see it's the black line, and that is labeled up at the top here. So this is your 10-year Treasury yield. So it's this black line that's the 10-year. The orange line up there is that 30-year, and the blue line is the 20-year. So it's that black line that gets the most press in the financial media. This is the kind of the benchmark security when you're just talking about interest rates in general. So as you can see, if I kind of use my mouse, notice this little hump right here in the middle. That's right around October of 2014. 14, somewhere in there. It might have been late 2013. But the point being, where we're at right now, over here at 3%, is the highest level since that little peak that we had in interest rates back there. We did close a little bit less than 3% here today, but at portions during the session, mostly in the morning, that's when we were up and over 3% just briefly. And that did cause a lot of negative consequences in the market, which is kind of interesting because, of course, a lot of people have been predicting that we're going to hit 3% for quite some time. I know I've had some tweets out there over the last few months that said, I can almost smell it. It's almost there. Well, the interesting part about it to me isn't necessarily that we hit it. It's that the market had such a negative reaction to it that it did today. Since it was kind of headlined and so many people knew that it would likely happen at some point, I kind of had the suspicion that the markets would not necessarily care all that much, but I was wrong. This was a day that we definitely had downside price action in the market, and that's why they play the game, right? You just never know how things are going to shake out. But of course, we had negative effects in things like home building and some of those interest rate sensitive areas like your real estate investment trusts and what have you there. So be aware that we don't have any inversion on the yield curve yet, but almost all of those different maturity dates, basically going back here since the fall of 2017, this level right here, all of them are now pointing higher at a pretty rapid clip right there. The other thing that I wanted to share with you is another chart that I've been building, and this is my volatility chart here. And just as a reminder, a lot of these charts are new, and so I appreciate your guys' patience. It's taken me a couple of weeks to build all this out. For those of you that are premium Market Scholars subscribers, you'll be receiving the data necessary to build your charts exactly like this here within the next week, so stay tuned to your email for that. But as we look at this volatility setup here, you can see there's a lot of different things going on, but one thing that I wanted to point out right off the bat is notice that we had a big down day today. Now I've got the Qs pulled up here, so if I wanted to, I could pop on over to the SPX, but it's kind of the same thing either way. Notice with the SPX, we were down 1.34% today. So I've got this percent change histogram kind of graphed on my chart right here. And I've got a couple different levels. So first of all, there's a zero line that's represented by that black line in the middle. And then the bars will go up or down by the percentage that that particular security, in this case the S&P 500, goes up or down in any given day or whatever the candle aggregation period is. So with this being a 1-year daily candle chart right here, you can see since we were down more than 1%, you can see clearly from a visual perspective that this red bar came down below this blue line right here on my chart, telling us that we were down more than 1% today. If you ever see the green candles go up to the blue line up above, that means we were up 1%. Now there's another level down here, which is 2%. And that's represented by the orange bars on either side as well. Of course, downside being the negative 2%, upside being the positive 2%. So we didn't have a 2% day here in the S&P 500, but when I was just looking at the Qs there a second ago, which of course represents the NASDAQ, notice that the NASDAQ got whopped today. Part of that on the backs of some lousy numbers from Google, or at least the market's perceived lousy numbers from Google. So notice that the Qs here, we are coming down here and touching that orange line. So a lot of markets getting worked over, and kind of like I mentioned in the past, we've seen a lot more volatility here in just the last couple of months, and that's why you see these really big bars up and down, both beyond the 1% and the 2% levels on up and downside, compared to what we experienced in most of last part of 2017 back in this area here. So anyway, that was kind of interesting to me to see such another big day. Now, if I flip it back on over here to the S&P 500, I did want to point out something else, which is if you look at the daily range up here, 66 points basically from high to low today versus the ATR of 39. So this was an outsized day compared to the average true range that we've had over the last 14 days or so. If I were to pop up the Qs again, try to get a sense of that, I'm sure it's the same thing, and it is. Notice that with the Qs, now this is the ETF, this is not the NASDAQ index itself, but this is the ETF that tracks the NASDAQ 100. The daily range for the Qs was 5.52 points, and the average true range is typically 3.25. So telling us again, today was an aggressive outside, very volatile type of a day for us here today. Now, of course, you can see down below, I've got this ADR plotted, ATR plotted as well. Had some help with that one there. And you can see that kind of curled higher after today as well, telling us again that average true range is starting to grow. Of course, after a day like today, that's just going to add to that calculation right there. And we've got that plotted here as a percentage, which is kind of neat. And then the implied volatility, same thing, starting to rise on that purple line down there. Implied volatility going higher as, of course, stock market starts selling off. We've got the VIX to VXV ratio chart plotted down below here, and that ended at about 0.99 here. As you can see on this label off to the left. Now remember what David usually says when he's looking at this, if you're looking for a long extended bull market in stocks, you'd like to see that ratio down there at 0.9. So it's definitely gone the opposite direction after a day like today, which is no surprise. And then of course down below we did have a big volume day on the Qs as well. It wasn't quite 1.5 times average volume. Whenever you get those days, you get these black arrows to show up on the volume bars down here, but you can see we were very close to that. Basically that gold band that you see above the volume bars down below would have signified 1.5 times. So we were knocking on the door of 1.5 times the average volume today. You can see that that volume bar is colored mostly in red, signifying that this was mostly bearish volume going into the market here today. Now, of course, the S&P 500, if I were to flip back to that for just a brief second, we actually got rid of our gains. We were basically flat going into the session today. You can now see year to date up here on my label on the top of the chart, we're down 1.46% on the year. So we can't really make up our mind whether we want a positive or a negative year so far in 2018, which is a little bit bizarre considering how things started. You guys will recall that January was actually a very good month. It wasn't until late January, early February when things really started spiraling out of control. So as we look backwards, we can see that we're down 1.5% on the year. We're down 7% over the last 3 months, but over the last 6, 9, and 1 year time periods, we continue to be up in the S&P 500. So shorter term bearishness, but the longer term bullishness still does continue to exist. If I were to take a peek at some of the other charts I've been building here, some ratio charts, kind of get a sense of what's been going on with one asset class versus another. What I'm really looking for here are either established trends or reversals of prior trends. And so as I kind of look at a few of these, you can see right here that commodities, this is the brown ratio chart right here, you can see that commodities versus bonds, that's what this ratio chart represents, is tracking higher, which is telling us that commodities is a stronger place to be than bonds right now. No surprise. Again, the 10-year hit a 3% yield. So remember, bonds prices work inversely to their yields. If yields are going up, bonds are going down. And we know that mostly commodities have been holding up reasonably well. In fact, that's part of the reason we've been hearing a lot about this pressure amongst the consumer staples sector is input costs are starting to go up to some degree. And of course, a lot of commodities going into those input costs there. Other trends that have been established, we do have oil versus gold right here that had been in a really nice uptrend with oil outperforming gold for quite some time, but this was a little bit of a reversal candle here today. So that's one of the nice things about these ratio charts is they'll actually show you the candlesticks themselves, which you can then apply your own technical analysis to if you so desire. One thing that I was pointing out to one of my students in my classes earlier in the week is foreign markets are kind of interesting right now, where we do find that it's the developed, established foreign markets that are beating the emerging markets. So notice that this particular ratio chart right here is emerging divided by developed foreign markets. So you're basically just unplugging the United States from the equation and seeing, okay, is it the growing foreign markets, or is it the kind of the slow growth already developed foreign markets that are leading the way? And when you see that this ratio chart is establishing a strong downward trend like this, it basically means the second element. In this case, the developed foreign markets are the leading category and the emerging is the lagging. And so we really start to see, maybe some of those areas in developed Europe or possibly Australia or Japan that are doing better than some of the more up and coming markets like your Pakistans and Vietnams and places like China and India, etc. Other things that I noticed on the charts here, look down below here. This is kind of interesting. This one in the blue, we've got the small caps versus the mega caps. This is the IWM versus the DIA. Kind of an interesting chart here where we are often running to the upside. So we're starting to see the small caps outperform the mega caps. Now keep in mind, today was an interesting day because of Caterpillar, because of 3M. Remember, the Dow Jones only has 30 companies in it, so they can be kind of pushed around by one or two of those higher price securities within it on a daily basis. But it is still an interesting thought that, it's the global trade that seems to be kind of stalling out right here, whereas maybe more of the domestic US based is hanging in there a little bit better. At least that would be one interpretation of looking at that particular ratio chart. You can also see something interesting developing here down in the orange. And by the way, if you wanted to ever zoom in on these, you can just double click and that'll zoom in on that particular chart. But notice this candle's basically going off into the right here. Basically telling us that the equal weight SPX is at its highest level on this 3-month chart versus the market cap weight. So remember, the normal S&P 500 is market cap weight. The way that you would think about the equal cap is trying to get a sense of breadth. And what it would basically be saying is that it's the smaller components within the S&P 500 that are outperforming the larger components. And for those of you that have been watching the FANG stocks lately, you'll know exactly why that phenomenon is occurring. Those FANG stocks have really been getting beat up here lately. And of course, most of them, your Facebooks, your Amazons, and your Googles, are some of the biggest market cap stocks in the S&P 500. Another outsized day you can see right here happened with this light green in the lower left-hand corner. And there, I'll blow it up there since you probably couldn't see that since my my camera feed was on there for a second. But this is the IVW and the IVE. This is the growth stocks versus value stocks. And, it's kind of interesting to me to see this candlestick about as ugly as you can get to representing today's action. And it's breaking down below a support area here. And so again, that's telling you that growth stocks are weak versus value stocks at the current time. Now keep in mind, this is a ratio chart, so this isn't telling you absolute terms. In all likelihood, growth stocks and value stocks were both down significantly today, but it's just that the growth stocks really got punched in the face. The value stocks kind of held up there a little bit better. So again, it's kind of giving you that impression of more of a risk-off type of a market environment that we're in on a day like today. Other thing that I thought would be interesting to look at here would be if I come over here to the Market Watch tab and take a look at our heat map, or some of you might call it a market carpet, and you'll get a sense real quick on what kind of a day it was. And this was obviously a very ugly day. A lot of names there in the red. Already mentioned several of them. So 3M was down massively today, over 7%. We have Caterpillar down massively today. Google, already mentioned that one as well. So a lot of those big name companies down significantly. Lockheed Martin was another one that really got clobbered here today. So a lot of red on the board. We had little patches of green here and there, and they're mostly in the more defensive areas of the market. Now, one other way to visualize this besides the heat map would be to click that drop down, go to Index Watch itself here on the Thinkorswim platform, and you can kind of get a sense of what the breadth was like today. And you'll notice here in the S&P 500, this is the public watch list that I'm pulling up here, we had 124 advancing issues, 374 declining. So obviously an overwhelmingly bearish day when you're just looking at this, just the breadth of the components within the market itself. So thought all that kind of information was interesting and thought I would shake up the routine a little bit compared to normal here today, considering some of the newer charts and of course the outsized crazy day that we had in the market. So now let's get back into some of our more traditional charts. And again, these are all the charts here that I've been working on over the last couple of weeks that you can see pulled up and to the right. And I'll reiterate one more time that it's all of you that are our premium Market Scholars subscribers that are already attending our classes that's going to have access to all of these charts going forward. So I'll go ahead and take a look at our market forecast chart now, kind of explain a few things here. So we are in a bearish posture. How do I know that? Well, the color coding makes it nice and easy. So I've got the S&P 500 pulled up here. Again, we were down over 1% today. But notice that the most recent color on the background is that dark red. And what that signifies is that the posture of the market is now bearish. Now, not only is it bearish, it's strongly bearish. Notice there's two different colors there. There's a lighter pink and then there's a darker pink. So yesterday we were in the lighter pink, meaning that this green line kind of rolled over just slightly, but was still above the 50th percentile on the market forecast. Today we rolled over in a big way, drug that green line down even further. Now remember, that green line is the intermediate line for those of you that are newer to it, but now we're below that 50 line. Remember, you can always get that out of my labels as well. It says right here, intermediate, 48.99 and falling. And so the chart background based off of this computer programming code that we have built in here already knows that ahead of time, and that's why it's plotting the background there is that darker pink color. So we have a strongly bearish posture in the S&P 500 as it stands at this current time. You'll also notice that the market sentiment line is starting to fall. So you'll see that I have my market sentiment line also plotted on the same graph as the market forecast. We don't talk a lot about it unless there's a change in direction. Well, today we do have a change in direction, so I thought I'd bring it up. But that dotted orange line that you see on that chart right there did start reversing lower here in recent sessions. So again, you can see market sentiment 43.95 and falling. So we would consider that to be a bearish posture on that even longer term posture setting tool as well. Let's take a quick peek here at some of our foregrids. And let's see here. Let's take a look at this one first and see if we have bearish postures across the board with all four of our major U.S. market indices, and we do. Now, in the case of SPX, which is the chart in the upper left, and the NASDAQ Composite chart in the lower left, we're in the darker pink color, telling us again we have strongly bearish posture according to the intermediate term line on the market forecast tool. On the other two charts, we're not quite there. You'll notice that those colors are a lighter pink. And so that's telling me that, yes, we have a bearish posture, but it's a weaker bearish posture. And again, if you wanted to double check the labels yourself, it says the intermediate term in this case is at 53 and falling for the Dow Jones in the upper right there. So again, it's telling us that the line is falling, therefore we are bearish, but we're still above 50, so we're not strongly bearish yet. And the same thing could be said down below for the Russell 2000. Now, back to my conversation there a moment ago about the ratio charts, take a look at what's going on just here within the indices themselves, not even on the ETFs. Take a look at what's going on here with the Russell 2000. It was only down 0.5% today. Now that's very odd. Normally when we have big outsized types of moves, you see the Russell 2000 as kind of a leader and a lagger in the extremes, with the thought process being that, first of all, smaller cap stocks have a higher beta, so they're typically known as more of a risk-on type of an area to go to, but also, you know, you can manipulate them a little bit more. You know, you would typically not think that you can just push around a company like a Google or a Facebook, whereas some mom and pop operator that maybe has a market cap of $3 billion, that's a little bit more manageable. So today was a little bit peculiar from that perspective. This is not the normal kind of you know, meltdown type of a mode that we would typically be in, because usually you would expect the Russell 2000 to really be one of the worst performers along with the NASDAQ. But today, Russell 2000 hung in there like a champ, only down 0.5%. So maybe money is flowing towards some of those smaller domestic companies and getting the heck out of the way out of some of those mega cap kind of international style of companies out there like your Caterpillars. All right, let's go ahead and take a look at our next chart setup. And this right here is going to be our 3 green arrows chart setup. So remember, the background colors in this case are going to be a little bit different. When you see the pink background like we do up here in the case of the Dow Jones, that means that we do have 3 red arrows, and we can count them right there. They actually all occurred today. Remember, they don't all have to occur on the same day in order to have that signal, but just out of coincidence, it actually did occur today on the Dow Jones. Here's candle number 1 as price closed below that falling moving average. Here's candle number 2 as the MACD went below the 0 line on the histogram. And here's arrow number 3 as the stochastics fell out of the upper reversal zone and is now trading down there at about 69. So we have 3 red arrows on the Dow Jones. We also have 3 red arrows down here in the lower left on the NASDAQ composite, but on the other two, the S&P 500 and then the Russell 2000, it's white towards the right. Notice there's no color like there is over here with the pink. So knowing that it's got white there tells me that we have a mix of green and red arrows, and you can see exactly why that's the case. We still have a green arrow in play on the moving average for the Russell 2000, green arrow still in play on the MACD, and we did get 1 red arrow on the stochastics here today. But otherwise, again, Russell 2000 is actually hanging in there pretty well. If we take a look at our longer term analysis now, remember this is going to be a 3-year weekly chart. Most of the other charts that we've been looking at until this point have been those daily candle charts. This is a weekly candle chart here, going back 3 years in time. And again, the background colors signify whether your conditions are bullish or bearish. Now remember, this is a longer term indicator. It's not sensitive at all. The last time we had any sort of switch in this was back over a year ago at this point when we had the bullish crossover. What we're looking for here is crossovers of the moving averages. Now the moving averages you see plotted on the screen in front of you, we've got an orange line here, and that represents our 10-period exponential moving average. And then the blue line will represent the 40-period exponential moving average. So like back here on the Dow Jones, this is way back in March of 2016. So basically we've gone 2 full years now since our most recent signal from this longer-term approach. We had a bullish signal at that time when the orange line went up and above the blue line. Well, as you can see right now, that orange line's inching towards that blue line. You can also recognize that down below in our MACD2 line because that's basically telling you the distance between the 2 moving averages. Once that line gets down here to the 0 line, it basically means that these 2 moving averages are crossing as well. Right now, we're not in any jeopardy of seeing the lines cross despite today's really ugly action. But again, I'll stress that these are not sensitive charts at all. This is the type of chart that you look at if you're looking for a strategy for long-term, maybe 401k type of money that you can't actively trade. So as it stands right now, longer-term trends continue to be bullish despite really ugly day from a short-term perspective in most of our markets here today. All right, so with that, let's go ahead and now talk about our trade application example for the day. I'm going to come over here to our options chart, and I'm going to pull up ticker symbol PM, which is Philip Morris. Now this is a stock that had quite a day earlier, actually not earlier this week, it was later last week. But anyway, or when was this? Maybe it was Monday. It was actually on the 19th, so yeah, I think that would have been last week. But anyway, they reported their earnings, and holy mackerel, this thing fell out of bed. It was down like 16% in one day. It was actually the worst day ever for this company if you look at it in its standalone history after it separated from Altria Group. Remember, Philip Morris International, what we're looking at here with ticker symbol PM, is the tobacco company that sells Marlboros internationally outside of the U.S. And of course, MO, which is company name Altria, sells the Marlboros and all the tobacco products here in the United States. Anyway, PM got smoked when it came to their earnings here last week. But as I mentioned in the intro, it's kind of suspicious that we didn't get an oversold cluster until today. Now you can barely see that on there because it's kind of being clouded by that low bubble right there. But there is a green dot right below our candle. And you can see down below if you need to confirm that with your eyes in the market forecast indicator itself. So again, when you get a bullish cluster like we have right now, here's what is occurring. We have the green, the blue, and the red lines on the market forecast closing in the lower reversal zone all on the same day. And the idea is that there is a greater chance for a reversion to the mean. There's no guarantee there, of course. There's never a guarantee in the world of technical analysis, but it may give you a sense that things have taken an extreme from one direction, and a reversion to the other direction is a little bit more likely than is typically the case. Now you will notice the last time we had a bullish cluster, was back here on March 23rd, and that would have actually been an interesting time to do a bullish type of a trade because we did get that reversion to the mean right back up into that moving average after that. So, of course, with this stock already reporting its earnings, that may be another interesting reason to do a trade. I know some of you don't like to sell options through an earnings announcement, and this would have been case in point and why that can be a dangerous thing at times. But in this particular case, that's already out of the way. And so in all likelihood, there's not going to be another 16% down move in front of us. And so I thought what we would do today is sell a bull put spread based off of that bullish cluster, an extreme signal here. Now remember, when we're doing a bull put spread, it's a good thing when volatility is higher because it means we're getting juicier premiums on that sold strike that we have. The other thing that I would point out about Philip Morris is it's currently yielding 5.19%. Its typical average high yield is 5.05%. In other words, its stock price has come down enough now where it would be viewed by income investors as an attractive income investment for the long haul here. Of course, if you had no moral problems with having a cigarette company or a tobacco company in your portfolio. But like I was telling my students last week when we were talking about this company, last I checked, smoking's not illegal. So there's nothing illegal about investing in a tobacco company either, even though I do respect the fact that some of you may just choose not to for your own personal reasons. But the other thing that I'd point out is that the current IV percentile rank, take a look at this purple label up at the top of my screen here. It is 62, so it's obviously in the upper half, anything above 50, so it goes from 0 to 100. So anything from 50 to 100 would tell us that we're in the upper half of the range of volatility. One more reason why we would have juicier premiums right now. And as I mentioned before, since we already had earnings, my little gray chart signal up here at the top says earnings in 86 days. So it's another 3 months until we have to worry about earnings from that perspective. Okay, so with all that out of the way, let's come on over here to the trade tab. Let's pull up PM, and I've got the May contracts pulled up with 24 days until expiration. And you can see I'm going to be focusing my efforts on the right-hand side here where we have the puts. And I'm going to be looking for a delta of 30 to start that process. And so you can see right here that the delta of 32 is highlighted. I was looking at this before doing the presentation today. It's kind of interesting because you'll notice we had a tremendous amount of volume here today. Now, we don't know whether that was bullish volume or bearish volume. That's the tricky thing about options because for every seller, there's a buyer and vice versa. But you will notice that we had a tremendous amount of volume and we have a ton of open interest in there as well. And so you wouldn't be alone when you're kind of participating here on these particular strikes. So what I thought we would do is right click on that 80. Now remember, when we're selling a bull put spread, the sold strike, in this case the 80, is where we don't think the security is going. So if you think it's going to go a lot further down than 80, then this is probably not a great trade for you. But I'm going to right click on that, go to sell vertical, and that loads up our trade down below. Now this one does have some 50-cent increments in there, so you have to kind of manually adjust things down below. So I'm going to sell the 80 put in May on the top line, and then I'm going to do a $2 wide here on that bottom line. We're going to buy the 78 put. Now that's going to create a credit of 45 cents. That's a 29% return on risk. Typically I'm trying to get that 30%, but sometimes you have to kind of relent to some degree knowing that we don't have 30 days until expiration here. So in a way, our annualized returns are still holding up because a lot of times when we're getting our 30% return on risk, we also have 30 days until expiration. Here, we have 6 less days that we have to be in this trade. So I'm willing to consider it in this particular case. So we have a $2 wide spread here. Basically, it's a way to say, okay, enough is enough with Philip Morris. It's created a bullish cluster. We're going to have hopefully a reversion to the mean here. If it doesn't, remember that's the reason we're buying the 78 put. If this thing continues to crater, anything below 78 we would not be responsible for. We'll still take a loss on the trade, but we won't have incremental losses as it goes lower if the same way that if somebody was selling a naked put all by itself. Here we're not doing a naked put. This is a bull put spread, so we have that built-in insurance contract right there. So let's go ahead and do 5 contracts here and call it a day. So confirm and send. Review this one last time. Everything looks great there. So let's go ahead and send that in. All right, we'll see if we get filled on that tomorrow. I appreciate you guys checking out the video here tonight. Hopefully you got some good insight and got some interesting ideas from the various charts I was able to present here for you tonight. Obviously a really chaotic day in the market. We'll see how things go forward, but remember right now we do have a bearish posture on the overall S&P 500, and of course everybody's keeping their eye on the 10-year Treasury yield right now, which did touch 3% for the first time today. So with that, don't forget to like and retweet on Twitter. Give us a thumbs up on YouTube if you get value out of these videos and you want us to continue doing them in the future. With that, have a great night, and we'll check back in with you a little bit later this week. Take care, everybody. Bye-bye.